Most people think that you need to take huge risks to make money investing, but it's not true. I started investing at 18 years old with just $10,000 money I saved from working at Subway. And no, I didn't turn that 10K into 400K overnight. I built my portfolio over time, not with one lucky stock pick, but through consistent investing, calculated risk, and taking advantage of opportunities when they came. For the past 10 years, I made a choice. No fancy cars, no fancy watches, no unnecessary liabilities or expenses. Instead, I aggressively invested a huge percentage of everything that I earned. And especially when the market crashed in 2020 and 2022, that's when I made my biggest moves. Today at age 27 years old, my stock portfolio is sitting at about $400,000, built entirely from scratch. No shortcuts, no handouts, and no rich parents. And that is not including my property, which I share over here. So in today's video, I break down how my portfolio is structured today, what I invest in and why. And more importantly, I also weave in investing lessons and principles I've applied from legendary investors and how it helped me to achieve higher returns without taking on excessive risk. But here's the thing, I'm not here to flex or claim that I'm brilliant. In fact, I'm still learning every day and the market consistently humbles me. I strive for one thing, to stay consistently average for long periods of time. Because in investing, that's all it takes to win. The reason why I structured this video the way it is because if I were watching it, I wouldn't want to just see someone's numbers and gain nothing out of it. I would want to understand their thought process, their strategy, and how I could apply the same principles. So if you're someone who wants to build wealth, stay invested for the long term, and make smarter investment decisions, you'll want to watch this until the end. Let's get into it. At 27 years old, my investment philosophy and strategy are fundamentally different from someone in their 40s or 50s. That's because I'm in what I consider the aggressive wealth building phase where maximizing long-term growth matters more than short-term stability. The way I see it, my biggest advantage isn't how much money I have, it's time. And time is the most powerful force in investing. Because when you're young, you have decades ahead of you for your investments to compound. That means that I can afford to take calculated risk. I can ride out the market volatility and I can focus entirely on maximizing long-term returns. That is why I invest aggressively. I'm not chasing quick wins or speculating on meme coins. Instead, I focus on high growth assets that have historically built wealth over time, primarily stocks because that's what I understand best. So I have 4 core principles behind how I make my investment decisions or my investment philosophy. And I'm not here to reinvent the wheel. I'm just here to follow time-tested principles that have built generational wealth for legendary investors. Number 1, I stay within my circle of competence. Risk comes from not knowing what you're doing. One of the biggest lessons I've learned from Warren Buffett and Charlie Munger is to only invest in what I understand. And for me, that means stocks or businesses. I only invest in stocks because that is what I understand best. I don't touch crypto, I don't touch private equity or any other alternative assets that I can't confidently analyze. I focus on businesses with strong fundamentals, durable competitive advantages, and industries I can reasonably predict for the next 10 to 20 years. By sticking to what I know, I invest with conviction. So when the price drops, I don't panic. Instead, I will buy more. The biggest investment mistakes often come from stepping outside of your circle of competence. Warren Buffett and Charlie Munger built their wealth focusing on what they knew best. The more I've studied successful investors, the more I've realized that conviction comes from understanding. The fastest way to lose money is to invest in something you don't fully understand. Because when the price falls, and it will, you won't have the conviction to hold or buy more. Instead, most people will panic and sell at a loss, and that's exactly how they lose their money and destroy their portfolios. By following hearsay instead of actual understanding. Number 2, I maximize long-term compounding over short-term gains. The stock market is designed to transfer money from the active to the patient. I rather invest in something that gives me certainty of compounding at 10% a year for 30 years than something that shoots up 50% a year only to have no idea whether it will exist in the next 5 years. I focus on businesses that can compound earnings over long periods of time, not short-term price movements. I don't chase hype stocks, get caught up in short-term trends, or try to time the market. I let my winners run instead of taking profits too early because the biggest gains come from holding great businesses for years, not months. The more I invest, the more I realize that time is the most powerful force in wealth creation. The best investors, whether it's Warren Buffett, Peter Lynch, or Charlie Munger, they're not looking for a quick gain. They're looking for businesses that they can hold forever. I want my portfolio to function like a well-oiled compounding machine, one where I can predictably put capital in, and with time and patience, I know it will grow. That is how I would want to build my wealth, with predictability and with a peace of mind. Number 3, I invest aggressively and take advantage of market crashes. The best opportunities comes when fear is at its highest. The biggest opportunities in investing comes when everyone is scared. And history has proven this time and time again. I don't fear market crashes. I know they will eventually come and I prepare for them. I keep cash ready to deploy during downturns because that's when high quality businesses go on sale. I don't react emotionally to volatility. I see it as an opportunity to accumulate more shares at better prices. Every great investor has one thing in common. They don't fear recessions. They capitalize on them. The more I studied market history, the more I realized that bear markets are where fortunes are made, not lost. That is exactly what I did in 2020 and 2022. While most people were panicking and they sold, I was aggressively investing and buying. And those investments are now some of my best performing positions.
Microsoft are down 30 to 40% from its high. The only time businesses like this are down that much is when it was in the 2008 financial crisis and the 2002.com crash. What this means is the next time you watch a video like this again is when both you and I are looking at each other with wrinkles on face at 40 years old. You see how crazy that is? For those who capitalized the crash in 2008 and 2002, they are now sitting on a big profit. Now the opportunities are here again. Are you going to let it sit and wait another 10, 20 years? Or are you going to make a decision to do something great for yourself? From me to you, I need you to be obsessed with buying assets for the next 2 years. Do me a favor, put it on your wallpaper, put it on your post-it note. I need money for assets. If you have excess cash flow and savings, you have one of the biggest opportunities in the past 10 years to build more wealth for yourself. There are going to be massive decisions for you to make in the next 2 to 3 years. And sometimes it is these few key decisions that change the trajectory of your entire life. From me to you, I need you to be obsessed with buying.
The real risk is missing out on long-term compounding. So my entire investment philosophy boils down to 4 things. I invest in what I understand so that I can hold with conviction. I prioritize long-term compounding over chasing quick wins. I take advantage of market crashes instead of fearing them. I focus on growth, not just capital preservation. And that is how I structured my investment decisions. It's not about being the smartest person in the room or trying to get the highest returns. It's about having a repeatable, disciplined strategy and the patience to let it play out over time. And as Charlie Munger said, it's not about being a genius, it's about avoiding stupidity. Now that you understand my investing philosophy, let's break down exactly how my portfolio is structured, what I invest in, why I invest in it, and how each part plays a role in building my long-term wealth. Before we get into the details, I want to mention something important. I won't be naming specific platforms, brokers, or fund houses because of conflict of interest. My focus is primarily on the investment strategy, the principles, and the allocation, not promoting any particular service, platform, or product. And this is what works for me based on my investment philosophy, risk tolerance, and long-term outlook. This is not financial or investment advice, and I'm not saying that this allocation is right for everyone. But what I will do is walk you through my reasoning so that you can apply the same principles to your portfolio. So at the highest levels, my portfolio is split into 2 major components, 60% stocks and 40% funds. And while I'm confident in this structure today, that doesn't mean I haven't made mistakes along the way. I've chased hype before, especially those ARK funds, and probably lost $20,000 to $30,000. But cutting loss on those investments was literally the best thing I've done for myself. I'm still sitting on some losses in some of my China equity funds, which I'll talk about that later. So I hold 55% of my stocks in the US market. Rather than diversifying across dozens of individual stocks, I take a concentrated approach, investing only in companies I have the highest conviction in. So I focus only on 4 major tech companies that I believe will continue to dominate the industries for the next decade or more: Google, Amazon, Microsoft, and Meta. I've been riding the gains of these 4 stocks for the past 4 or 5 years. The biggest mistakes I made along the way is taking profits too early. At certain points of holding these stocks, I thought I could sell at the top and then buy back at the dip. But I was completely wrong. I've missed out on huge windows of gains in these stocks because I thought I could outsmart the market. If I could go back in time, I would have just let my winners run, ignored the noise and just kept investing consistently more into these stocks. So why these 4 stocks? Here's 3 quick reasons why this allocation makes sense for me. The first reason is because they have deep economic moats, which means that these businesses have built-in competitive advantages that has made them incredibly difficult to disrupt. Google still dominates search, Amazon controls e-commerce and cloud, Microsoft owns enterprise software, and Meta still has a massive network effects across its platform. Reason number 2, they have strong fundamentals and they generate strong free cash flow. A business can't compound for decades without strong cash flow. These 4 companies print cash quarter after quarter, allowing them to reinvest, buy back shares, and expand into new growth areas. And reason number 3, they are leading the 6th wave of innovation, artificial intelligence, and digital transformation revolutions. Instead of trying to guess the next big AI startup, I invest in the giants that already have the capital, the talent, and the infrastructure to dominate these trends. While my portfolio is heavily concentrated in US tech, I also allocate 5% of my portfolio to one of Singapore's bank, DBS. Why? Because Singapore banks are some of the strongest and most stable in Asia. They provide a layer of stability and diversification to my portfolio, and most importantly, it's patriotic too. Some might ask, why only have 5 stocks? The answer is simple. Because I already have 40% of my allocation in funds, and I believe I'm well diversified enough. As Warren Buffett said, diversification is protection against ignorance. It makes little sense if you know what you are doing. So this is where funds comes in. What if I actually don't know what I'm doing? At least I got my funds to be my safety net. It's my exact thought process. So I have a 30% US market exposure, 20% of it in the S&P 500 and the other 10% in a 100% tech fund. Why? Because while my 4 core stock holdings in the US markets are strong, I still want to ensure that I always capture the overall market growth. The S&P 500 has historically delivered about 10% annualized return over the long term, and it has always go up over the long term despite world wars, epidemics or financial crisis. And because of the time horizon I have, it's a sure win. The only reason why I don't put 100% of my money into the S&P 500 is because it's very diversified and I do not need so much diversification. And that is why I have 10% in a tech-specific fund which give me broader exposure to high-growth tech companies beyond my 4 main stocks. This allows me to benefit from other emerging tech leaders in case I'm wrong. And then I have a 10% international market exposure, 5% in China tech equity, 3% in the Japan equity fund and 2% in the India equity fund. Why? Because while the US is the dominant market today, global diversification is key to reducing risk and capitalizing on growth outside of the US. So here's where it gets interesting. This chart here illustrates the difference between GDP growth and local equity index prices returns for various countries since 2009. The key takeaway is that GDP growth doesn't always translate to stock market returns. Just because a country has high GDP growth doesn't mean its stock market will generate high returns. If you look at China, everyone is saying how advanced China is right now and how fast they are growing and whatnot. But because of the geopolitical and regulatory risk, it doesn't reflect in the stock market, which is why I'm still at a negative position in my China right now. I use a fund to diversify my China exposure to reduce any single stock risk. The reason I bought it is because there were a lot of great companies that were trading at huge discounts and I thought that it would be a great buying opportunity. But what I've learned that investing in US and investing in China is not the same at all. So I'm still holding on to losses here and I've learned that China carries unpredictable risk. So I'm keeping my allocation small and not adding on to China anymore. I only recently got into 2 new small positions, probably less than 12 months, into a Japan equity and an India equity fund. These are still new investments for me and I'm still learning as I go. One of the reasons why I bought it is because Japan is undergoing major corporate reforms that are pushing companies to be more shareholder friendly, leading to more buybacks, higher dividends and improved efficiency. Japan is also home to some of the world's strongest companies in automations, robotics and semiconductors, which is in line with the 6th wave industry. I'll be monitoring this closely and will update you guys along the way. India is also a new position to me and I'm still refining my understanding in the India stock market. The reason why I bought into India is because it's one of the fastest growing economy in the world and the GDP actually reflects the stock market. And with global companies diversifying away from China, India is becoming a key manufacturing hub and I want some exposure to their long-term growth. I'll continue to track this investment and share my thoughts as I learn more. So all in all, why this allocation makes sense to me is because it is structured to give me high growth potential through concentrated stock positions, diversification through broad market funds, international exposure to capitalize on global trends, and some stability through Singapore Bank. And as you can see, I'm actually very tech heavy, but going down into the next 1 to 3 years, I actually will go heavier into tech because of this video over here. Okay, check it out if you haven't. And there's another reason why I still choose to stay diversified. So I serve clients in the investment space. When my clients ask me about certain markets or certain asset class, I want to have actual skin in the game. Having real money invested forces me to stay engaged, stay accountable, and continuously refine my own investing knowledge. Because at the end of the day, investing isn't about being perfect, it's about being consistent. The worst mistake investors make isn't picking the wrong stock. It's not staying in the market long enough to let compounding work. What you should never do is blindly copy someone else's portfolio. Because investing isn't about what someone else is holding, it's about why you're holding what you hold. So whatever your investment strategy is, be patient, stay invested, and let compounding work in your favor. Alright, if you found this video helpful, let me know in the comments. What's your one biggest lesson you learned from your investing journey? I'd love to learn from you as well. And if you're serious about building wealth for the long term, consider subscribing because this channel is all about simplifying investing and helping you to make smarter investment decisions. Alright, that's it for today. Thank you for watching and I'll see you in the next one.